Good morning, good afternoon, good evening, wherever and whenever you are watching this, and welcome back. Matt Cormier, Michael Seatner here with you for another, I guess what we would call probably our quarterly edition
Yeah.
of what's happening in the Toronto office leasing market.
Or whenever
Thanks for
you
being
feel
with
like
us.
it. Yeah, we're just here to talk. When there's good stuff to talk to you about, we come to your homes and share with you our insights on how you might want to come back to the office.
It seems like the busier we get, the less frequently these podcasts come out, which is given by the gap from our last one in April. It means things have been busy, which is a good sign.
Interesting insight, but on that is to let our viewers know is if there is everyone's thinking about what's happening in the office, is the office dead? You want a leading indicator of what's happening in the office market. It's how busy brokers are. And I know, Matt, you could probably say the same thing. The last 3 or 4 months have been crazy busy with companies starting to either do deals or think about what their future office is.
No doubt. The conversation has totally switched from where it was even 6 months ago, certainly from where it was 12 months ago, or 15, 16 months ago when the pandemic started. But I would say the conversations over the last 3 to 4 months are not about what are we going to do, it's how are we going to do it? How are we actually going to get back? So what we want to do today, we're going to break this down into kind of two sections that I don't think even calling them sections is the right word. We're just going to call this two different, kind of parts of the same conversation, two sides of the coin, if you will. Why don't we break down, Mike, quickly, kind of where the Toronto office leasing market is today, and then probably more importantly, what our clients are starting to do for their, as we're calling it, the return to the office. This isn't a return to work. People have been working for the last 15 or 16 months still. This is their returning to the office. So we'll start to break down what we're seeing both statistically and anecdotally from our clients as they look to re-enter their Toronto offices. So Toronto office leasing market as a whole. So we, as of the end of Q2 2021, are at 9.8% in terms of our availability rate. Now, I want to put a big sticker beside that, a big asterisk beside that. About 40% of that available space is sublet space. Why I think that's important, and we can talk about this, Mike, obviously. That means the landlords who obviously own that space are still being paid rent on it. So functionally, I think we're much closer to a 5 to 6% vacant market than we are a 10% vacant market. Really important to keep that in mind as we move forward.
There's an interesting, and for our viewers, an interesting dynamic of being out in the market right now where there are a lot more subleases. There's also direct space that's come back. And I think that the biggest surprise that you're alluding to here, Matt, is there's not a lot of great deals out there, which might be shocking to our viewers, but the dynamics of why are just to what you said, where landlords are sitting on effectively 6% vacancy, which is still extremely low. For some context, if you were to look at a market like Chicago or even in the suburbs of the GTA, you're in a double digit mid-teens vacancy that it's been for the past 5 to 10 years. So landlords sitting at 6% aren't excited to go and chase deals and give you really aggressive terms. They're still saying we're pretty optimistic about our portfolio.
So sure, I understand what you're saying. The caveat to that, though, is pre-COVID, pre the pandemic, downtown Toronto was at 2% vacancy. So even in the best case models right now, it's tripled compared to where it was at that point. Whereas even suburban Toronto has actually stayed flat. Your point is valid, even though the suburbs are between 13 to 16% in terms of vacancy and availability, depending on the market. That's actually pretty much stayed flat during the pandemic. So you could actually maybe even you could even make a counter argument that downtown's been hit worse, just given that statistic. But your caveat's correct about the landlords. I would make an argument that they are being more aggressive right now than we certainly were pre-pandemic. Maybe not as aggressive as they were 6 months ago when people still weren't sure what this world looked like as we came out of it.
And to that, like I think I would say that we had passed the bottom of the market, and that's based on it's really less about vacancy, and our vacancy rate is going up. And even that stat that Matt mentioned, we're seeing a deceleration of space coming back to the market as companies start to slow down putting space on the sublease market, getting rid of space. They're starting to think about reoccupying and getting actual deals done.
Well, so let's just quickly, Mike, before just to give our viewers the context. So Downtown Toronto, I think we said about just under 1.6 million square feet come to the sublet market at the absolute height of the pandemic, which would have been now 12 months ago.
Mhm.
Really, in that initial, after the first 2 or 3 months, once people realized this was a long-term issue, at the height, we saw about 1.6 million square feet hit the sublet market. So, in terms of that 1.6 million square feet, just rough numbers, about a third of that has been leased. Let's call those the high quality spaces. You know
Right.
them when you see them. They're high quality build outs, they're high quality buildings, they're high quality furniture, they're term options that are attractive, they're price options that are attractive. I think
It
everybody
just
could,
intuitively makes sense, right? The first stuff, the best stuff in the market that's cheapest turnkey, that's going to go first. That's the cream of the crop.
and not even, I think interesting, not even necessarily cheap. All right. It's
Mhm.
not like these were quote unquote huge reductions in rent to sublease these space. In fact, some of these had multiple. I was in multiple offers earlier in this year on a couple different sublet opportunities because there was more tenants chasing high quality sublets than there were high quality sublets.
So
So
let's
let's
pause
just
for a second because this is
yeah.
important for our viewers. So you were in competing offer situations on good quality sublease space. It doesn't sound like anybody got a deal at all, really.
Well, I mean, define what getting a deal is, Michael. Right, and I think this is what it comes back to. Even if you walk into space anywhere between 80 to 100% recovery for the sub landlord. For the subtenant coming in, there's perhaps a little bit of an adjustment on the face rate that they wouldn't pay in open market, but they're walking into potentially taking over $150 per square foot in build out costs they do not have to absorb. They're taking
Yeah.
over furniture, 100, what do you want to say, $50 a square foot for proper sit stand desks, for meeting rooms that are built out with full, AV equipment, TVs, the like. So there's potentially up to a $200 per square foot cost savings. So
Right.
I would push back
You're
and
getting a
say,
good deal, but you're not going in and saying, I'm going to start bullying these sub landlords because I don't care how nice your space is.
right,
It's good space is going to go. You're getting a discount because you're not building it, and maybe you're paying the rate that they had paid when they did the deal. But it's not like you're going in and lowballing these great subleases.
right. So again, that was, call it, a third of the sublet space that hit the market. It has leased, it has subleased. High quality covenants coming in to nice space in the marketplace. Another third of that space, so one third, one third, one third, one third of that space will not be sublet. Full stop. It's not a matter of the sub landlord is being too aggressive in terms of their asking rate. They're likely low quality spaces, not well built out, perhaps either too long on term, conversely too short on term. It's not a question of if I reduce my rates by 10%, I will have someone in this. At this point, I don't anticipate about a third of that space to be able to sublet.
Yeah, you almost couldn't give it away.
Right.
Yeah, and we have
And
a lot
then,
of clients and tenants who are doing that. They want to put their space in the sublease market. They have. There's a mixture between your situation of multiple offers. We have some great subleases and deals we did that had that situation. And we also have certain subleases that we barely had a tour over the pandemic. And it's
that's right.
reflective of the good quality space and the good quality buildings that are built out that went. And we're sitting on a lot of subleases that it might take a long time for that stuff to move.
Yeah. And then, of course, the other third is sub landlords who have now realized we need to reoccupy this space. We put it on the sublease market 12 months ago in the height of the pandemic, and we're now getting ready to and we're going to talk about the stats here in a second, our return to work model or return to office model. And we need that space. And I think we've seen that probably on about a third of the sublets that have hit the market.
Yeah, so that's fascinating. So, and like viewers, important point here, there are a lot of companies who have pivoted on their office space, who said, we're working from home forever, get rid of the space, dump it, and have then subsequently taken their space off the sublease market. One of our clients did this actually even a little bit earlier, around February, March. Our client TMX, they said put 50,000 square feet on the market at, brand new LEED Platinum building, only a couple of years old, and have since found that business has done well. They're going to get more occupancy than they thought, and they've taken that space off the market. They're not the only ones who have done that. And this makes sense because as we start to get towards the end of this pandemic, we don't know if we're going to have back to full occupancy or 50%, whatever it is. So unless you can get an amazing sublease recovery, which may or may not happen, you're likely waiting and seeing and a lot of your staff were saying they're going to come back to the office, at least you have that office space ready to go to put them in, and then maybe we'll see some of that come back to the market a year from now or not at all.
Right. So just to put a pin in the conversation on the Toronto market, you can see very quickly how a 9.8% available marketplace ends up being a 5 to 6% available marketplace. And then quite quickly, as people get their return to office plans in place, how that could quickly again become a 4% vacant marketplace. We don't have the new developments hitting the market like we saw in 2017, 18, and 19. Anything that's hitting between now and in 2024 is essentially fully leased. So it's not like we're going to have a huge amount of new space on the market that'll help inflate these vacancy rates as well.
So Matt, you're probably having some tough conversations with your clients as well, who are coming in and saying, COVID, I'm in the market for space. I'm going to go get some great deals right now. You're probably having some challenging conversations that have to reset expectations.
Yeah, I think that's a great point. And part of the conversation that we're having as much right now is how do we manage the return to the office strategy with what's realistic in the marketplace. And depending where your clients are based, that's a huge impact. For example, I think we both have clients, whether it's New York, Chicago, all across the US, who have said, well, in New York, rates have been slashed by 50% and our vacancies, tripled to 30%. I don't know the numbers exactly, but I'm thinking it's pretty similar. Whereas in Toronto, it's always with the caveat of, well, we've tripled, but it's from 2% to 6%. We're still owned by an institutional ownership group. Good news is your face rates won't increase, but they won't decrease. But there'll at least be some sort of an inducement included in your deals now. And here's how we're going to do it for you. So it is a tough conversation, but that's just the fact of the market right now.
It's almost like to illustrate this further. It's like you look at a market like a Chicago that was here in the middle, and they went in COVID to a high vacancy. So they had normal market dynamics, and now they've shifted to very aggressive tenant favorable dynamics.
Right.
We started all the way over here where we had an extremely tight landlord's market. And now that we're pivoting back to the center, we have moved, like you said, more inducements. You are getting a better deal than if you did this in early 2019, but we've only moved to the middle. We're now in a more normal market dynamic, which is why you can get a better deal than you did before, but it's not the sky is falling. It's not lowballing. It's not like there's a need to be aggressive on.
So let's talk about why that is in terms of people returning to their office. Because that is really, a big caveat here is, well, why are we talking about the market becoming more favorable to the landlords? Is because more tenants are looking for space right now, potentially looking to increase footprints. So most recent stats in terms of what the plans are to go back to the office. So I'm going to give you the stats, and then I'm going to give you anecdotally what we're hearing. 80% of people who were recently polled in one of our JLL polls, I think it was over 2,000 employees across various organizations and industries, 80% want to be back in the office. So breaking that down, so you have 54% are expecting or looking for a hybrid model. We'll get into that in a moment. 26% are saying, I want to be back full-time, Monday to Friday again, get me back to my desk, get me back to my life. I'm excited. And 20% are saying, I'm okay not coming to the office anymore. Doesn't mean I necessarily want to work from home every day. Ironically enough, in that split of the 20%, 50% or 10% of the overall number actually are looking to work from home full-time, where the other 50% or 10% of the overall number are looking for various options, maybe working from home, maybe working with coffee shops, maybe going to various places across the city or the GTA. So 80% of the people want to be back to work. I think an interesting part of this poll, and I don't think this will surprise many people, but when polled in terms of these overall people, the average amount that they would like to be back in the office is 2.9 days per week. Call it 3, for lack of better terms. People are expecting to be back in a hybrid model or wanting to be back in a hybrid model, ideally for about 3 days a week.
And that's interesting. Just to piggyback on that point, is the sentiment is at 2.9 days a week. And another big JLL survey we did across thousands of clients in our benchmarking group found that the most optimal employee engagement and basically in sentiment around the company is 1 to 2 days a week from home, 3 to 4 days a week in the office. That's kind of that peak of the curve where you're getting the most out of your employees, and you have diminishing returns when you force them into the office 5 days, and diminishing returns when they're only forced to come to the office 1 day a week or don't have the ability to work out and where they want.
A lot to break down there. I think an interesting word that you put in there was forced. Anecdotally, we're not seeing a lot of our clients right now mandate. We're not seeing them mandate what people need to do for a return to work model. You shall be in the office 3 days a week. You shall be in 5 days a week. You shall not be in at all. Really, what we're seeing right now is employers start with flexibility. Now, and again, we should say this repeatedly. This is as of today. Let's see what 6 months from now brings. Let's see what happens as people start to get back to the office. But we're not seeing our employees or our clients, sorry, mandate their employees be back a certain number of days. I think they're all doing internal polling. They're all getting a feel from their employees on who wants to get back. I think one of the really interesting things that I've seen, and this is anecdotally, but I think we're going to see it come true, our employees aren't, or our clients aren't affecting or changing their office space based on this feedback. For example, Michael, if you said, I only want you back 3 days a week, that means in theory, your occupancy levels is 60%, right? 3 days a week. But in reality, your people are going to be back in Tuesday, Wednesday, Thursday.
Right. It's your full capacity Tuesday, Wednesday, Thursday. Guess what days people don't want to come into the office? Didn't take a scientist to figure that one out.
Well,
and it's interesting. How does that change your square footage? It probably doesn't in a lot of situations.
Well, and the interesting takeaway of is, which was my second part of this, is that we're not seeing anyone, or I'm not seeing my clients go much more from a 1-to-1 desk to employee ratio. I think part of the flexibility is we're going to give you an opportunity to come back in the way you want to. For most people, that's coming back to their station desk. They know where they sit. They have the picture of the kids and the dogs and the family. They have, if it's like me, Mike, as you know, it's a spotless desk with my water container, my coffee mug there ready for me every single morning. That's just how I operate. I panic when I don't know where I'm coming in. In fact, over COVID, it's been very difficult for me even to come to the office because I don't have a stationary desk anymore. Sitting down at a different place every day, I'm very comfortable now in my home office. So, I've been in, as you know, a couple of days a week over the last few months. And that's been the toughest adjustment for me, is not having a stationary spot. Now that will change. We will go back to a 1-for-1 desk ratio. This is just still for distancing.
Right. And it's thinking about, that point of forced again, and understanding where that optimal point is for most companies is, yeah, more work from home means more empowerment, more flexibility, and maybe the chance to reduce your real estate costs. But when you force people to work a certain way, you get that diminishing return. Well, a great analogy would be almost like a university library. When you're at school, you can study how and where you want. You study best at home, you go home. If you study best in the library, you go to the library or on that desk on campus. Some people like the noise, people like the silence. Having an office as a place that invites people to come work so that they can be productive to work how they want to work best, whether it's 1 day a week at the office or 5 days a week, whether it's in big open collaborative areas or having that small quiet area to get your work done. That's the environment that's going to be the best for everyone, because it gives everyone what they need to be the most productive.
Right. And I think a huge part of this is, what's the job function? Do they work on a team? Are they siloed? Is it an individual contractor, for lack of better terms? I think what we're seeing a lot right now, and I think, you and I, as we track all the different companies and what they're doing. I thought Apple was quite interesting. They said, we'd like 3 days a week for you to be in the office. If you want to be more, fantastic, but ideally we'd like you in 3 days a week, because we want to foster collaboration. As much as Mike and I love sitting here on Zoom together, we were in the office a few days together last week and probably bounced 3-4 ideas off each other that we wouldn't have normally thought of, because of just, hey, Mike, did you hear this? Oh, Mike, I heard you just saying that. For us, that's actually revenue generating. I can't put a number beside it. I can't quantify that, but I can tell you it's revenue generating. So with Apple, they said, if you're going to be in 3 days a week, we'd like you to target Monday, Tuesday, Thursday. Reason being, we'd like all of our people essentially back in on those same days. And anecdotally, that's what I'm hearing from my clients a ton right now is, well, candidly, if I have a 4-person meeting and 2 of us are in a boardroom and 2 of us are on Zoom, does that really help me? What's the difference between just all of us being at home then at that point? So I think what we're going to see is a lot of people look to target the days that they have their staff in, totally understanding that maybe 3 days is the optimal approach. Maybe for your business, it's 5. Maybe for your business, it's 1 or 2. But having people back in together, that collaboration that comes from seeing each other. And I think we've seen that pendulum switch, change throughout COVID. those first couple months, it was all work from home forever. And now it's gotten to a point of I can't wait to get back and at least have those interactions and those conversations. So we
Yeah.
are seeing that pendulum switch pretty aggressively right now. I think the need for collaboration is back. And again, as I said, let's see what happens. The next 6 months will be very telling. As everyone probably listening to this, at least our Canadian viewers will know, the vaccine rollout was slower here than it was within the US. With that said, it's really taken off. So we will, we've essentially seen this, whereas the US kind of is seeing more of a steady lineup. We saw a hockey stick style line. So now everyone, it's been very reactionary to say, well, I am double vaccinated now. I'd like to get back. And companies are reacting to that.
Yeah, and speakers, we save this probably for next time because we'll have more deals to report. But the activity in the market right now, especially with big global tech companies, either expanding in Toronto, opening brand new offices in Toronto that have either done deals or are currently active looking for deals in big blocks of space, is a big testament to everything we're seeing, where there will be return to the office. It will incorporate this hybrid approach, this flexible approach, but people do want to come back. Big tech is investing in that, as they've been successful in the past. And in the next podcast, we should have a few really interesting deals to tell you about, showing how big tech has doubled down on their office space, albeit will look slightly different than what it might have looked like 2 years ago.
Well, and it's not just doubling down on their office. These companies are doubling down on Toronto. We just helped a client out, Pinterest. They took space for up to 300 bodies. I think they're only, I don't know what the exact count is right now, but it's about triple what they were in terms of a square footage basis. They're not 50,000 square feet. I know we're working with multiple ones right now who are looking to expand here in Toronto. That has been targeted as kind of the next major growth opportunity. We've been saying that and seeing that pre-COVID, but I think it's on a different level right now where Toronto and Vancouver, even to probably a lesser extent, is becoming the target for big tech. We will see them. And you and I said this on a podcast probably 8 months ago, back before the new year. I think we said you'll see big tech lead us back to the office. And not to give ourselves credit, but we are starting to see that. So I think you're right. I think that's, we'll be able to really report these deals as they happen over the next couple months. And that is a great opportunity on the next one to bring you back in and hear that part of it. So with that said, Mike, I think it's probably a good point to wrap up, leave the people wanting a little bit more for next time. Like always, thank you, Michael. Thank you everyone for listening and following us. And like always, feel free to reach out if you have any questions, you'd like more on these stats. We're always happy to talk both office leasing here in Toronto and what we're seeing on office space at large, because we like it and it's our passion.
Always a pleasure, Matt. Yeah, always happy to continue these conversations. It's a fascinating time to be thinking about commercial real estate.
It'll be fun. It'll be fun to track this over the next 6 months. Let's see what happens with the hybrid model. Let's see if people start to get back and they say we want to be back full time. Human beings have short memories. Let's see if we end up being back where we were pre-COVID. Let's see if this is here to stay. I think at this point, we're probably more reactionary than we are proactive, which is the first time in our careers I think either of us have been able to say that. It's almost a point of let's see what happens. So until next time, let's report back on what we're seeing. Thanks, Mike.